Hey everyone, I'm Mike Klein, CEO of Digital Wealth Insider. You know how everybody says be fearful when others are greedy and greedy when others are fearful? Well, guess what? That's really hard to do. But we love to hear those stories of success, don't we? The entrepreneurs and the investors that had the odds stacked against them and they were able to persevere and be successful. Seth Levine is our first guest joining us today. He's a personal friend of mine, an author, wonderful human being, and partner at Foundry Group. Seth, thanks for joining us.
Hey, Mike. Good to see you, man.
Founding partner of Foundry Group. Easy, right? Easy to start a venture fund.
You make it sound more dramatic or more important than it actually was. But we're like old school venture now, which is funny because when we started Foundry, we were like emerging managers, like younger people. And it's amazing how fast, probably 5 years after starting Foundry, we were in a pitch meeting, and it was so hard to raise our first funds. Foundry started in 2006. We raised our first fund in 2007. It was really hard to raise our first fund. There wasn't sort of this category of emerging managers in the way that it exists now. And eventually we got it raised, and sort of that's a great part of our history. And I can go into that if you're interested. But like 4 or 5 years later, we were raising another fund and we're sitting with some investors, and they looked at us and said, when do you get too old to do this, right? To relate to founders and have fresh perspective. And I was like, wow, is the half-life short? Truly, yeah. 5 years ago, we were like too young and fresh-faced, and we could barely get an investor to take a meeting. And then 5 years later, it's like, well, you're probably a little long in the tooth to stay in venture, which I thought was fun.
That's hilarious. And when you launched Foundry, it seems like even the venture class itself was more nascent, and just like people weren't as confident in that asset class in general. Would you say that's correct?
Well, I think the biggest thing that's changed, Mike, which is and you experienced this as well, but back in 2000, so there's obviously this huge spike in the number of venture firms in the early, late 90s and sort of 2000. Then the bubble crashed in 2001. And then It took forever for firms to just sort of work their way out of the system, right? We can talk about that as it relates to today's environment as well. But by 2007, 2008, there was sort of an opening, maybe, but the conventional wisdom at the time, which is totally different than it is today, was totally different than it is today, was that if you weren't in the top 5 or 6 venture firms, you shouldn't be in the asset class. So if you were, that was Sequoia and firms like that, Kleiner Perkins, if you weren't in those couple of firms, then you shouldn't even be in the asset class. I mean, I remember when Excel, which is this very famous venture firm that's done extremely well, I remember when they were struggling to raise a fund, right? And this was sort of the 2007, 2008 timeframe. And there was, and people forget this, but there was all this chatter about is Excel done? Are they gone? Now, of course, they ended up being the big investor at Facebook and had a couple of other really big companies. And now no one has that conversation anymore. But that was the context of 2007, 2008, when we were fundraising, was venture was this asset class that really was 5 or 6 names, and then everyone else was just sort of taking up space. Obviously, that changed. I hope Foundry had a little bit to do with that. And today, I think people think a lot more broadly about sort of venture exposure and the venture business as an asset class.
Yeah, and that's super insightful. And let's talk a little bit about, when you were raising the fund and you were going through the hardships. I want to talk a little bit about the hardships there, because I think it's inspiring to our listeners. But also, how important was your inner circle and the relationships you had, in the sense of, I'm sure there were a lot of people that were betting against you or assuming you wouldn't be successful. And I think that's reoccurring when you're doing anything contrarian or against the grain, essentially. Can you talk to us a little bit about that?
Yeah, well, let's talk about the power of failure. And look, I mean, I'm going to turn this question back to you, because you also spent some time trying to raise a more traditional venture fund and then moved away from that to do something else. And I think sometimes what you learn from those processes leads you to something else, right? And so in our case, we were able to get our fund raised, although, I think people sort of hear about Foundry and think that it was somehow easy to raise money and that it was sort of always a success, but that was not true at all. And in sort of we started fundraising in end of January 2007, and by May, it seemed pretty clear to us that the fund wasn't going to get raised. We had a couple of small commitments, no big commitments, so much so that I actually vividly remember kind of coming home one night and having a conversation with my wife where I said, I don't think it's going to happen. And it's expensive even today to raise a venture fund. It was even more so then. We had like an offering memorandum and just like some old school stuff that doesn't exist anymore. But it was, the legal fees were a lot because that was a big legal document that was hundreds of thousands of dollars to produce. And then just going fundraising was also expensive because you're flying all over the place. And so for me, it had been kind of an all-in moment, right? I hadn't really made any money in the bubble and, enough to put up my share of starting Foundry, but that was it. And so I went home and said to my wife, like, I don't think Foundry is going to happen. And I feel terrible. Like I lost our life savings, even though it wasn't a lot, it was our buffer. And that really sucks. And she said to me, I think it's going to happen, give it a little bit more time. I mean, it was awesome. It was one of those sort of seminal relationship discussions that you have where you're like, I got it. My wife's got my back. Like, that's awesome. But, maybe it was a month or two later and we got our first big commit, and then all of a sudden it kind of dominoed and ended up happening. But that was a really challenging moment, and I learned a lot from that. But in our case, we decided to keep pushing forward, and we eventually were able to close the fund. Now, by the way, we managed like $4.5 billion. It's ridiculous. But I'd throw that question back to you, Mike, because you tried to raise a more traditional venture fund, decided that it wasn't going to work. And then, ended up pivoting or changing to crypto bulls. So I'd love to kind of get your perspective on that question as well.
Yeah, 100%. So, I was at a few venture funds, held a lot of different positions, like early and late stage. And I'd gotten to the point where I thought, and maybe naively, that I would be able to just go out to the market with this emerging fund and it would be a quicker success. And the partnership that I had with a founding investor at the time, there was a third party involved. There was a little bit more understanding, hey, they were going to raise the capital. And, I think you were involved in some of this. And it was just like, okay, maybe they aren't going to be able to raise the capital as easily as they thought. And I think that's how it always goes, right? Is you get excited about this new thing that you're going to pursue, right? It was probably the same with Foundry Group. You're going to hit the market, and then, you kind of get punched in the face, right? And to quote Mike Tyson, everybody's got a plan until they get punched in the face. And then it was sort of like, what are we going to do here? And I had already been sort of increasingly attracted to crypto. And it was such a new asset class still, especially with the alternative coins and all those different things, that it was kind of like, what is this, right? And I believe now it's just venture capital 2.0 in the sense of with this liquid component, right? So what I really understood is that this fund wasn't going to launch, but I've learned a lot here. And it's also made me double down on my convictions in the digital asset markets. And so ultimately, like you said, it was the failure to success. It was essentially, okay, and there was a big part of me that it was hard to let go of being a venture capitalist, if that makes sense. And in the sense of now I still view what I do as alternative investing. I would argue it is. I would argue actually my venture capital, background of 10 years really enabled me to be successful in crypto investing. But if I hadn't had the learnings, and if I hadn't had sort of that failure, I would have been less equipped to launch my crypto fund.
Yeah. Well, look, I mean, famously, there are, and the list is so long, I'll just give a couple examples, but there are so many companies out there that started trying to do one thing and ended up doing something completely different. There's actually a great book that I would recommend called Quit by Annie Potts.
Okay.
And she also wrote Thinking Bets, which is a fantastic book. I absolutely like it. I'll tell you a story about that a little later. But I would recommend that every entrepreneur read that, right? Because we can get stuck in our ways and say, okay, this is what we're going to do, and we're just going to do it until we, until it happens, right? And the truth is, sometimes you need to take a step back and look around, right? And the stories that come to mind are stories like Lyft, right, which was Zimride, which was a sort of a go home for spring break college campus ride share ride pooling thing that wasn't quite going to work, right? So they pivoted into what is now Lyft, or I mean, even more famously, Slack, right, which was a video game company, and they had built this little communications thing for their developers to better better talk to each other during the day and coordinate, and they decided that the video game, which had some early promise, but they decided it was never going to really work, and so instead they decided that they would focus on the communications tool that they built. There are dozens and dozens and dozens of examples of huge companies that were the result of sort of a, like a side project, and it became the whole business, right? So I think being open to how that changes, your trajectory, I think is really important.
Yeah, you bring up a great point. Look, like in my experience personally, but also everyone successful I've observed, it's never a straight line to success, right? It's all these twists and turns and pivots, and you essentially adapt and you learn to overcome how dynamic life can be and the business world. And ultimately, I think that's what positions you for success, is because you have to continue to evolve, you have to continue to grow, and you have to continue to push your concepts forward. And the ability to do that, I think of the analogy of like almost a captain, where you want to hire the captain that at any moment a typhoon can hit and they know what to do because they've been in this situation before.
Yeah.
Not only they've been in a typhoon, but they've gone from smooth sailing to typhoon. And so they're always thinking, I'm going to be prepared for the turn of events that may occur. And I think it's also helped me to experience that myself, to be a better investor. And I want to talk a little bit about that, Seth. Like, how has your personal experiences raising Foundry Group, your ups and downs, how's that changed your and craft your approach when you're sitting on boards now of startup companies and when you're advising startup founders?
Yeah, I mean, I'd go back even further, Mike, because I think what you just said is really important. I want to double down on that, which is this idea of being directed, but being open, right?
Yeah.
So, like having a sense for the direction you're trying to go in, but being very open to sort of the way in which you get there, right? I mean, so one of the things I really enjoy doing is sailing. So speaking of your typhoon captain of a boat thing, but I really like to sail. And one of the reasons I really like to sail is because you're in control, but within some content, within some parameters, right? So obviously, for the most part, when you're heading from point A to point B, it's not a straight line, right? It's in sailing, it's called tacking, but you can only sail so close to the wind,
Right.
and so you need to be like open to that. And one of the things I really like about it is you kind of can't be in a hurry, right? The wind can die down, and you could really want to get back and get off the boat, but like the wind is the wind, right? You have to just sort of take your time. And when I think about like what the types of people that I've met that I think have been most successful, not in business per se, but in life, they are people that are able to be at least a little bit open to kind of changes in direction. It's interesting because it reminds me my very first job out of college, I worked for Morgan Stanley. I was an investment banking analyst. A lot of type A personalities, and I had a huge imposter syndrome when the whole time I was there, because I went to a really small liberal arts college. Morgan didn't recruit from. And so all of my classmates were basically people who went to schools I could not have gotten into, or in some cases didn't get into. And so I was like, I kind of had this imposter syndrome the whole way. But what was really interesting was the types of people that attracted tended to be more like planners. And I can think very clearly, this is, I graduated from college in the mid 90s. So it's been a while now. So people, are well onto their careers. And there were a handful of people that were like this when they were 22, like very clearly, like, I'm going to do these 5 steps in this order, and this is what's going to happen. And they've kind of had that career that I think was kind of boring, actually. And the people and these are high achievers, very smart people. The people from my analyst class who I think had the most interesting careers were really just sort of open to the ebbs and flows, to keep our sea analogy going, but open to some minor changes, right? And so had general direction. This is the kind of stuff I'm interested in, but we're like really open to what exact form that took. I think that's really important advice in life, right? Is to be a little bit flexible in terms of what's next, and be open to that.
Yeah, it's such an interesting point. I was thinking as you were talking, I used to, I mean, well, I still do, but I talk to a lot of people that, they build wealth for the first time or they have success for the first time. And you can tell that they're a little uncomfortable about losing it, a little uncomfortable, about kind of how they got there. And then you talk to somebody more experienced and you realize, especially with contrarian investors, that they've had sometimes massive swings in their wealth, right? And this is the same with founders. You have founders that have built companies that were valued at $100 million and they own 20, 30% of the company. And then that stock ended up being worthless. And you notice that there's a subset of those people, they just keep going. And what happens is there's something that you can't take away, which is that confidence, like, I'll do it again. Right. And so I get
Yeah.
knocked down, I have a huge loss. And this obviously is prevalent in crypto, which is, it's one of those things where it's really easy to talk about somebody that bought Bitcoin really early and how they have a lot of wealth today. But it's like, look, they could have woke up every day and sold, and they had conviction and they were able to take massive swings in their wealth. And besides like that one investment class, when you talk to these more senior people, and when I think of like you and I think of Brad and the guys at Foundry Group, it's like, if you had to start from scratch tomorrow, you're very confident, I'm sure, like, I would figure it out. And
Yeah.
that
Do
is
it all
something that
again.
I've always aspired to have because it's something that no one can take away.
So let me ask you a question, Mike, because I think one of the big differences between what you were doing in venture and what I do in venture and what you're doing now, which is essentially a hedge fund, is that you can mark to market every day and you, for the most part, have liquid investments, right? So,
Yep.
I can BS myself about the value of some company. And by the way, I mean, I know I'm wrong, obviously, at any given moment in time, but I have an opportunity to ride a company up, but then, if I have to mark it down, I can still rationalize, no, we've got these great things going on, and I think it's going to ultimately be successful, whatever. In your market, that's you can still rationalize that there's upside, but you can't fake what the price is today, right? If you have an investment in whether it's a coin, token, whatever else it might be, you know what that's worth because there's a market to trade it. I'm curious if you kind of thought through the differences between being measured quite so accurately and deliberately in the crypto world, the hedge fund world, versus the venture world where it's kind of smoke and mirrors.
It's a great question. So we could unpack this all day. I'll start with a story. So there's a guy that lives across in the building across from the building I live in, and he works for a hedge fund and in New York, like a big one. And they do public equities. But he was complaining about confiding in me a little bit. He's got this newer analyst, and every time they have a meeting with a CEO, the analyst is either extremely euphoric that they should just like triple down on this investment, or just like panicking because he thinks like they should exit. And we were talking about this experience that you get with understanding that there's a natural high and low that's built into all businesses. And it's kind of, do you have a long-term thesis that you're holding against? And I think this is very prevalent in venture. I think the difference a little bit in venture is that you're generally illiquid. So you have to do all your homework up front, and then you just support the entrepreneur and the founding team the best way that you can for them to be successful. But as well as I do, Seth, like that any founder, when they talk about the success story, and everybody assumes it was just this straight, like, oh, it just was like Facebook. Everybody just assumes it was like a seamless growth to the company it is today. It's full of these ups and downs. And in venture, of course, like, you really don't price to market except generally like every few years or when a round occurs. Maybe that's different as you get a little bit later stage. But in crypto, it's all the time. It's real time. And people
Yep.
react very, very, very sharply to any sort of news. People in general act, when I think of Contrarian not doing what the crowd's doing, because generally the crowd is being very reactive. They hear a little bit of information. It's so funny you asked this question. Yesterday, there was some interest rate data that came out that got blasted on Twitter. And it was basically showing an inversion of the yield curve. Crypto markets immediately started to go down. Well, guess what? It was false data. And everybody like started to react to that in real time. So you have a lot of noise, right? And I think this is when I alluded to why did venture really position me to be successful in crypto? I think you've got to have a long-term thesis you're investing against, or you're just going to get drowned out by the noise. And, if you could price startups in real time, I think you'd see similar volatility, right? You talk to an early stage startup and they say, we just got off the phone with Microsoft. They want to do a pilot and their stock price suddenly goes through the roof. And, every investor wants to suddenly get into this company that was sitting on the sidelines and assuming there would be a liquid market like crypto. And then, 3 months later, hey, Microsoft decided they don't want to be a customer. They did the pilot, or they decided they no longer want to do the pilot. You'd see a similar type thing. Or if the company had to pivot, right, you'd see a lot of fear in the markets. And so you're seeing, I think, in crypto with the volatility, you have to understand why is there volatility. And a lot of it in the short term, especially, is not fundamental at all. Now, sometimes there are fundamental things that happen with these different projects, right? You may see like a hack occur and the price certainly will respond to that. You may see that a key team member leaves, or that you can see insights into that the core founding team is starting to sell their tokens, because it's all transparent and it's all on chain. And those are fundamental things, but there's also a lot of noise you've got to weed through. And that's really how I kind of explain to people, you're going to be in for a choppy ride when you invest in crypto, because it's still very much retail driven, and retail can act very illogical, as in many money markets.
Yeah, and I think one of the things that you're actually describing, and so let me put some words to it, is there's a difference between investing and trading, right?
Yes.
So if you're trading, you of course care about every up and down, because you presumably you like volatility, right? That's how you're making money, getting in and out of some asset, right? Whether that's stocks or crypto or whatever. But what you're describing, and this is what venture is, and what crypto can be, doesn't have to be, but can be, is investing, right? And that's playing longer arcs, and you're better off to ignore the short-term ups and downs, because you have a long-term thesis. And so you can evaluate, hey, do I still believe in this thesis? And if you don't, then in your world, you have a way of getting out. In my world, I maybe don't continue to invest in a company, but I can't always get out in the way that I'd like to. In fact, I can rarely get out in the way that I'd like to. But that's the difference between investing and trading, right? And I think that that's really important. And it reminds me of a Warren Buffett quote, which I really, really like, because it speaks to the investing mindset, and it is a nice contrast to the trading mindset, which is much more short term. But Buffett said something to the effect of, I'll paraphrase it, when everyone is being greedy, you should be fearful, and when everyone's being fearful, you should be greedy. Right? Yes. Because he takes the investment mindset, which is, hey, I'm not worried about what's going to happen tomorrow or next month, and maybe even next year. I need to know what's going to happen 5 years from now or 10 years from now. Right. And I feel like that, when I hear venture investors say, oh, well, such and such market is out of favor, and so I'm not going to look at this business. And, usually I pull out that quote or whatever, but I'll push back and say, okay, is the reason that market's out of favor because there's a fundamental issue with it and you just simply believe that there is no future for that market? Or is that market out of favor because some high profile company, blew up, or you had one company in your portfolio that was doing such and such in that market and it didn't work out, and so now you don't want to look at that market anymore? What do you think that market's going to look like in 5 years or 8 years, right? Which is the average hold between Series A and selling a company, Series A investment and selling the company. That's what you really care about, is where does that company go? Now you got to pay attention to can I raise money for it in 18 months when we need more money? I mean, there's some steps along the way. But I think people often forget that. And, that's why venture is so prone to these hype cycles, because everyone piles into the same thing. So that sort of by definition, they're kind of too late, right? Because when everyone is already identified it, then we overfund some sector. And then there's some other sector that's being ignored, that is the place that, that people should be spending their money. And it's funny, Mike, when I think about some of our biggest wins at Foundry, Fitbit comes to mind in particular, just because it was such a big win for us. But when we went to raise the Series B for Fitbit, we couldn't get it raised. No one liked hardware. They didn't believe in the market, et cetera. There's a bunch of things they just didn't get. And we ended up leading that round ourselves. It was actually one of the reasons we created an opportunity fund back before everyone had them, was because we wanted to lead that round. And that, I don't remember the exact math, but that $10 million that we put into that round turned into, it was hundreds of millions of dollars, right? It was a lot. It was, that was a really good economic return just from that one round. And that's been true of a bunch of companies that we've had that have been successful, where it's not always sort of up and to the right. And you sort of made this point a little bit earlier, but companies go through ebbs and flows, and sometimes it looks great, sometimes it looks challenging. Some of the companies you early on, you think this one's a rocket ship to the moon, end up failing, and others that you're like, I just don't see it. But they keep grinding, and then they become the Slack instead of the video game company, right? And so we've had a bunch of companies struggle to raise some round in their existence and then go on to be like massively successful.
And you bring up such a good point. It's like, obviously I've experienced this as a VC. I've also experienced this in crypto, probably even more extreme, which is, I was telling somebody the last bear market. First of all, like, as a contrarian investor, I think what you by definition believe is that where other people are seeing fear, you're seeing opportunity, if it still matches with your long-term thesis. And so, the more that people are negative on a sector, assuming, like you said, you can still get the company funded and have success, the more excited you are to invest, because there's not like that crowding that we talked about where valuations are really high. And it's the same in crypto. And, I was joking last bear cycle, it was half a joke because bear cycles are always hard, but it was like, if I had a time machine and I came back and I said, I know for a fact, Bitcoin is at some astronomical price in 4 years, I don't think there are that many people, if any, that I could convince any better to invest in it. Like knowing perfect information, because people's mindset is very much fear driven. And I also believe that when they're hearing on the news all this fear, when they're seeing from what they view as a sophisticated investor, like you mentioned, hey, we don't like that space, they do tend to like follow this herd mentality. And that's one of the reasons why I launched Digital Wealth Insider, is I wanted to encourage that contrarian thinking, because it's hard. It's hard socially, right? Like most of the time when I'm at a party, I'm, the crypto guy, and I'm like, nobody knows what to do with you, right? And I'm sure you had a similar experience being in venture, especially early in your career, where it's like, oh, you're the venture guy. And especially when it's like the markets aren't frothy, that everyone's thinking your investments are going to go under, or like you're investing in Fitbit, and they're like, oh, that's the Fitbit guy, right? He's the Fitbit guy in the corner. And it's like, ooh.
Well, everyone always, it's like black and white, right? Like venture's doing well and people think you're, like, oh yeah, your job's easy and you're just making money or whatever. And then, when the markets are down, people think like, oh, that's, what a stupid, career to be in. And, oh, by the way, you're just like at the casino, right? Like, are you really good at what you do? Or is it all just completely stochastic and luck? So one of the things I think is important, and you sort of, obviously this is a contrarian podcast. Let's talk about like, what are the fundamentals of being contrarian? It's incredibly important to evaluate decisions based on data at that moment in time. And I think what ends up happening is people like to look back in time. And obviously there's this human tendency to think like the stuff that was non-obvious back, way back when, should have been obvious, right? And I think that people waste a huge amount of time doing, I love the idea of doing postmortems on deals that worked or didn't work. I hate, and we've had our own versions of this, where, it's so easy to just like clip the treetops and be like, hey, that deal ended up being a failure. That was a dumb investment. This deal ended up being successful. That was a good investment. I totally call BS on that, right? You got to go back to that moment in time and say, based on what we knew then and our prediction of what was going to happen, was this a good investment, good place to put our money, good team to put our money behind, or not? And if the answer was not, what were the red flags that we missed, right? Why did we say yes when we should have said no? Or why did we say no when we should have said yes? And I think that that's work that people rarely ever do, right? And so, if you're back from your time machine, what the future looks like. I mean, that's obviously, that'd be lovely, right? We'd all be rich, and that's what we're supposed to be. We're supposed to have some view on that. But the truth is, you can't do that, right? So all you can do is say, hey, I know a bunch of things now, and I should make this decision based on what I know now and a reasonable belief of what the future is going to look like. And that's the basis for that Buffett quote of being greedy when people are fearful, and fearful when people are greedy, which is to say you should actually understand the time that you're in. I'll tie it back. I referenced this book when we were talking earlier at the beginning of the podcast, but I think that's the sort of the essence of that Thinking in Bets book by Annie Potts, right? Which is really about, she's a poker player, so I'll use a poker example, but every once in a while, a 2-7 is going to pull a flush, right?
Right.
Or a straight. And that doesn't mean that you should have ever played it, right? So the right thing to do is always to fold the 2-7 is the worst draw you can get in poker. You should always fold that, even if it turns out that would have been a winning hand in that particular case. And I think that's the point that she makes really eloquently in this book. And it's funny. Josh Koppelman, who's a relatively well-known VC, was the founder of First Round Capital. He and I went for a walk maybe 2 weeks ago now. And somehow the topic of that book came up, and we were both talking about just how much it influenced, because I think Josh, like me, likes to be specific about what he believes at any given moment of time. And then when you're doing a postmortem on a deal that worked or didn't work, be specific about not, it didn't work, therefore it was bad, or it did work, it was good, but be specific about what did we think, what did we need to believe at the time, and why did we have a basis for that belief that made us make the decision that we did. And it's interesting because I haven't actually had that conversation with any other VC, certainly not in the context of that book. But I think that's why it's such a powerful read for so many people, is because that's just not the way most people's brains are wired. And I think it's a mistake, especially when you're in a business like venture, but really any investment business where you're placing a defined number of bets over a period of time, and you can measure whether you were right or wrong by outcome. And I think it's an exercise that every contrarian investor should do, right? Which is to think back at what did they know at the time they made an investment, and do a real postmortem and use it to create a feedback loop to improve what their investment strategy is.
Yeah, I love that. I did a write-up on this. I'm a poker player, and it becomes very...
And you wrote about the book, actually.
Yeah, I wrote about the book, and it's this mindset of it's called in poker results orientated. And the idea is, if you go to any poker table and you see somebody with a big stack of chips, most people assume they're a really good player. And you have to say, well, what defines a really good player? And it means, are you making plus EV decisions, which is just a way to measure if you make this decision 1 million times, on average, will it be profitable or not profitable? And some of the most exciting stories, like you said, are people that are more gambling. And I think that has actually a very good contrast to the crypto markets and alternative asset markets, where there's just people that are gambling. And there are always going to be people that get lucky, because in a sea of 1 million people, there are people that can make all the wrong moves and still get rewarded. But that's not useful information for you, right? What's useful is, what is the playbook? What is the playbook for success? So for instance, when I was looking at entering crypto, the first thing I did was read articles and talk to as many people I knew that had been really successful, had built up a large amount of wealth. And I found occasionally I talked to some trader, right, that got lucky on a trade, or I would talk to somebody that kind of just YOLO'd in and forgot about it or whatever. But when I looked for the formula was, I have a thesis that this is going to continuously be more valuable. I'm investing according to that thesis, and I've been holding for a really long time. And so I realized that the best approach was to simulate the approach that had the strongest indicators of success, right? And it's the same as you mentioned with 2-7. If you play 2-7 1 million times, you're going to lose a ton of money. You're going to meet somebody that made a ton of money playing 2-7. In fact, sometimes weird poker players
on one or two hands, right?
Right. They have a hand that's their favorite. Doyle Brunson, famous poker player, his favorite hand's 10-2. It's a horrible hand, but he won some big tournament or pot, or I don't know the exact story with it. And so it's his favorite hand. So people tend to, the crowd mentality is to focus on, especially I think in Western society, is who made the most money. And really that is what they look to for a sign of this person's smart, and I should do what this person says. I think back to the 80s and 90s when you had all these videos preposterous videos of people on cigarette boats and flying in from helicopters, and then they're selling some product on TV. And it's like, you don't need to know about me. You just need to know about how rich I am. And it's like, well, that really doesn't tell me
Right.
anything. And I don't really know where you're going to end up in 5-10 years. You're probably going to lose all the money if you made it in a poor EV way. So I love that analogy. And I think that's one of the cool examples that poker can bring in a microcosm to investing, which is, kind of thinking in terms of not results orientated, but do you have, like you said, a good process? And do you have confidence that process will more likely yield positive results than negative results? And, in venture, you're going to have companies go to zero. And it's the same, I think, in crypto. You're going to have certain projects going to go to zero. But the ones that do well will more than make up for the ones that do poorly. And that obviously is like the thesis of any
So let me
system.
ask you a question, Mike, let me ask you a question about a corollary to what we're talking about, which is that essentially every day you're making a decision, an investment decision, right? People think that they make it, if you buy a stock, you buy the stock one day and that was your investment decision, but that's not true, right? When you're in a liquid market, every day you're deciding to invest in that stock. So if I bought, Tesla at, 200 and it goes to 250 and I hold it at 250, I've just made a decision to invest in Tesla at 250. Now in the venture markets, there isn't a liquid market. And so I may have companies where I don't want to continue to invest, but there's no way to get out of it, right? Although there is, we can talk about this later, but there is a sort of sunk cost fallacy, if you will, that I think affects a lot of investors. I think a good contrarian investor learns not to fall prey to that. But in your new business, you will have the opportunity for much of the assets that you hold to sell at any given moment, which means that every day you're making an incremental investment decision. And I'm curious if you've kind of thought through that, right? Because it is, again, in venture, you sort of make an investment, you obviously try to maximize it, but you very rarely have an opportunity to sell sort of along the way, right? Occasionally that happens. And then occasionally you have an opportunity to invest more or not, right? So those are the discrete points in the road. But in the new hedge fund world that you're working with, you actually are making an investment decision every day. I'm using it mostly just to highlight for people that are listening that to be a true contrarian investor, you need to be thinking every day, everything that you have an opportunity to sell, you are now making a new investment in.
Yeah. And I think it's a great way to think about it, Seth. So, let's take actually the Tesla example because it's very similar. So, when I think of like investing in Tesla, which I've been a Tesla stockholder, for example, for a while, it really goes to a core couple principles. Do I think EVs and electric energy in general, or alternative energy sources, are going to be more popular or less popular in the next 10, 15 years? And it's like, okay, my answer is more. And I write that down. And then I say, okay, do I think that Tesla is positioned from a leadership perspective and from all metrics that I can gather, right, financial information, whatever, do I think they're going to be one of those leaders? Do I think they're going to benefit from that trend? Yes or no? And it's yes. Then if those things don't change, I don't sell, right? If one of those things changes, I revisit my investment decision. And so these people that, essentially are going off news, or the price is high or the price is low, I don't know how they do it, because it seems exhausting to me, because you just get in this circular thinking that's really not based on anything fundamental. And so it's kind of the same in crypto. It's, do I think this technology is going to be more popular or less popular in 10 years? And then what needs to happen for that technology to have increasing adoption and be successful? And who are the companies and projects working on solving those problems? So I think, macro blockchain, I think what sectors within blockchain are necessary for there to be success. So you talk about like interoperability, you talk about the ease to off and on ramp, you talk about transaction speeds, different things like that. Those are sector categories. And then I just simply pick baskets of teams that I think are working on solving those problems that are likely to be the leaders. If something happens where I no longer think that sector is applicable, or then I have to revisit all those investments in the sector. Or if I think something's happened with that project, right? Key leadership has left, and that was one of the reasons why we invested. Or core metrics are way down, and one of the reasons we invested is because they were sort of acquiring more users and more capital, which is called TVL in crypto, which is just another way to say assets under management. If I think that those are indicators, not of just, the market being the market, but I'm seeing trends, then I may decide that this fundamental investment, this specific investment, is no longer an investment I wish to have, or it's an investment we should have less of. So the other nice thing in crypto is nothing's binary, right? Like where I think in venture capitalists, you're going to think if we're going to exit or if we're going to shut down this company, that's a binary event. In crypto, I can reduce my exposure by half. I can diversify into a competitor by half. And there's nothing wrong with that. And so really, like, that's how I approach it day to day, is I'm looking at fundamental on-chain metrics, but they're all really against my overlying thesis. And what's interesting about crypto is there are so many problems being solved that you really have to be in crypto to even understand the value of the problems, right? Because that's where the technology is. Yeah. There's projects that are solving really good problems to solve that will be really valuable if they solve them. You're only going to know about if you're in those ecosystems because you don't care about otherwise. And then there's the thesis of crypto moving over to mainstream. I think that still is a little ways away, but it doesn't mean that there aren't a lot of like monumental successes to be had from companies and projects that are solving problems within the ecosystem.
Yeah. One of the things I really like about this discussion, Mike, is that it really highlights the difference between investing and trading, right? When you're investing, you care about these fundamental questions. What do I need to believe over a long period of time? And you can address those questions on a regular basis and see if you still believe in your investment thesis. When you're trading, I'm going to oversimplify slightly, but when you're trading, what you really care about is what do other people think? What are other people going to believe over the course of the next, day, month, 3 months that will move the stock, right? So then you care a lot more about externalities, things that don't relate to the fundamentals of that business, because you're just trying to get in and out and ride some momentum. Now, again, there's nothing wrong with that per se, but I think if you want to be an investor, you need to be thinking in the way that you just described and care about what your own thesis is, not relying on others or the market to have that thesis on your behalf.
Yeah, I mean, it's a great point, Seth. And, one of the reasons why I launched Digital Wealth Insider is I realized there was this fundamental problem, especially for people that are newer to the crypto space, where they're unsure even how to look at the asset class. And I thought about that, and I realized, given my background, I almost instantly associate it with venture capital, but how that's actually pretty unique and novel. And I'll give you an example. If you go to any crypto conference, you can, and I believe like your tribe is very important, right? Having like-minded people, like you mentioned, the executive you went on a walk with, having like-minded people in your circle is really important, because then when you bounce ideas or concepts off of them, it's within the parameter of you have similar alignment with how you view investing in the world. And so you're not getting like all sorts of weird data points. And, when I go to any crypto conference, the same thing happens where, if I want to go find the degen crowd, which the degen crowd is famous in crypto, it's when can I get my Lambo? It's basically what you said. What token can I buy that I think is going to pump? I don't care if it has fundamental value. I mean, literally there's meme coins, right? So I don't care if it has any fundamental value or anything. Do I think this is going to go up and will I make money? It's very easy to find that crowd. It's also easy to find the crowd that is, crypto is a safe haven from the government, the libertarian angle. And so I want to put as much wealth as I can in Bitcoin or some other digital asset, one of the basic ones, to protect my assets from inflation and different decisions my government may make from a monetary policy standpoint. But there's not like a really intuitive place where you can go this is a really exciting investment sector. I want to invest in this sector and diversify against a long-term thesis, the way that I've approached investing in general, right? Like with stocks or real estate or venture or any other asset class. And what I wanted to do is create a place where, one, we could share stories of what it's like to be in that mindset and really have a tribe type mindset of, look, where are people fearful? And us being us, should we be more excited now that the general population's fearful, right? When crypto is popular, is almost always when we're like at a burst bubble time, right? And I think it's the same in some of these venture investment cycles that you talked about. When nobody cares about crypto anymore and nobody's interested, well, that's when a contrarian investor gets really excited, right? Because that's where opportunity is.
Yeah, without a doubt. I think you just summarized it actually quite well. It is. I mean, there's so many examples of markets where they were out of favor. One of my favorite is when I started investing, when we first launched Foundry. I was a young partner. I was newly minted as a partner. I was not. I'd worked in venture before, but I was a principal level, so not partner level. And I was like, well, what am I going to go do? When there weren't a lot of people in New York running around investing, which is funny to say now, but back in 2007, 2008, that was actually true. So I spent a bunch of time in New York, and I fell into ad tech. I thought that was a really interesting sector to spend some time in, and it was very much out of favor at the time. And I think part of what attracted me to it was that it was out of favor, and I felt like, well, that's a good time to get into it. And then fast forward 3 or 4 years, we had one in particular, hugely successful company. We seeded. Back when seed rounds were like, we did a $1 million round at a 3 million post was the seed round back then.
Way back in the day.
And then we sold it a couple of years later. Yeah, way back in the day. But we sold it a couple of years later to Google for $500 million. It was a really successful investment. And but by then, it seemed like I was getting 20 ad tech investment decks a day in my inbox, and that was when I actually kind of stopped and took a step back and said, okay, now it feels like there's too much going on, right? There've been a couple of successes, and it's maybe time to take a step back. And I think, the venture market tends to work opposite of what I just described, which is that people we're seeing it in AI today. Everyone's rushing to AI at the expense of some other markets that are really potentially interesting. And there have been examples of this over time in various markets where it becomes very out of favor. And then 4 or 5 years later, there's some company that was started when it was out of favor, or usually several companies that were started when this market was out of favor, that end up being hugely successful because, of course, who wouldn't want to be in a market that has fewer competitors, et cetera? Now, you got to solve for the funding challenge, all that kind of stuff. But I like the way you just described it. I think it's exactly right.
Yeah, it's just like, okay, do you have a thesis and are you staying true to that? And I've seen a lot of VCs do exactly what you said, Seth, where they'll look at a sector, it'll check all the boxes from an independent due diligence perspective, but they'll just be like, it's just been beat up. And my mindset is always, great. You want to double, triple down, right? And I think most of the stories that inspire investors and entrepreneurs are essentially stories of somebody carrying out and executing against that, where they got excited, and the more and more the naysayers kind of knocked at the door, and the more and more that they heard people say, hey, not good to be there, it's dead, whatever, the right person gets excited about that. And conversely, I mean, you saw, I think, like a perfect example is I saw a lot of VCs when they're in hot sectors, they're not even doing due diligence. They're just assuming somebody else did, oh, this big company like Sequoia's in this deal, so we don't need to do due diligence. And you saw that like with FTX, for example, right? Where everybody just assumed, oh, well, who's in the deal? Oh, this VC's in the deal. Oh, well, then we don't really need to do due diligence. And, look what happened there, right? And it's so, it's easy to like, obviously with, us being in the future, to look back on those things and point the finger. But I think what's more important is to say, like you said, revisit what was wrong in the process. And those things come to light pretty quickly when you're doing popularity investing.
It's funny. I have an FTX story that relates to this point that you're just making. I was in Dubai. This was last year, I guess, and I was meeting I met with a bunch of folks there. I was meeting with an investor, and this was right after FBX, like right after FBX melted down. Yeah. And this investor was telling me that that Sam Bankman-Fried had been in Dubai. I mean, I think it was like a month prior, like really recently. It was to try to save the business. And he was like, I was sitting there in a meeting, and he was pitching me on this idea and telling me how amazing it was. This is when he was trying to pull $1 billion in or whatever to kind of keep the Ponzi scheme going. And this investor said to me, I was sitting there thinking, why is he meeting with me? Right? Like there's all these really sophisticated investors, one already on his cap table,
Right.
Sequoia, Tiger, others. And then two, other sophisticated investors that are investors in crypto. And he's sitting there investing in me. What does that say about, like, am I the sucker essentially? Like, why is he sitting there talking to me about this? I thought that's exactly right. And he obviously turned it down. But I think that was very insightful of him to kind of, instead of riding the wave, to be like, wait a minute, there's something else going on here, and I should think about it, look into it.
Did you have any aha moments like that in your career where there was a popular investment at the time, and you guys just were like, some sort of red flag, or it didn't match up with your thesis? Have you guys had a handful of those, and could you share one?
Well, I mean, all the time. So I always hesitate to share names just because it's not. But there's so many high flying companies that come through, where it seems like it's sort of a fait accompli that things were going well, um, and I just, it seemed like too good to be true, and it usually is, right? And I tend to focus on the opposite just because that's kind of how Foundry's mindset is, which is we tend to like to think about those times when we placed a bet when other people were running away and we
Right.
were running in. Um, One of my favorite examples of that is a company that we sold to a private equity firm a couple of years ago called Integrate. And there was a moment in time when the business just seemed like it was going to fail. And the CEO and he had recently taken over from his co-founder to be the CEO. We really sat down and kind of dug through the business, and we had a glimmer of what it could be. And we ended up completely recapping that company. It was a $9 million post-money valuation on the recap. And, it took us a little while. That was probably 6 or 7 years to get to the sale. But, we sold it for $400 million, and actually more than that, because we sold it for $400 million and we still kept a portion of our ownership. So we did ended up being a nice deal. And he describes it as like in a burning building, everyone's running out. And, he and I were kind of running towards it with buckets like, hey, I think we can save this. So, I
Yeah.
tend to focus on those, but every venture firm has examples of companies that, it turned down and did incredibly well. And a bunch of others that, it turned down and they were kind of high flying. It seemed like, it was like, what an opportunity to get this name on our, on our list of companies, and we turned it down, and we're really happy we did. So it's hard because there's a bias towards remembering the ones that were extreme outliers. So,
Sure.
I've got the list of companies in my head that we didn't invest in that turned out to be really successful. And by the way, we've done the exercise that I suggested, which is a true postmortem, where we said, what did we believe at the time that made us decide not to invest? Because we were clearly at least wrong about the outcome. Now, it may have been that we were right about the investment at the time. And of course, in some cases, right, we just couldn't have gotten in, right? I mean, the number of people that are like, oh yeah, I should have done the Twitter Series B or whatever. And you're like, yeah, I mean, there aren't 30 firms who were going to get into that round, even though there's probably 30 firms out there that, described that they had missed that, right? So it's a little bit
Well,
challenging sometimes.
and look, I mean, to be fair and kind of recap everything we've been talking about, Seth, like the point is like if you took a profile like Twitter, and from what I read the book Hatched, and the company seemed to be a mess, especially early on. Like they were hiring
Yeah.
and firing the same CEOs. There was like CEOs that were the CEOs 3 times, right? Like, and a bunch of the founders were involved romantically in one person, like the same person, and it's like, okay, so forget that we know that Twitter was successful. If you knew those things were going on in a company and you had, 1,000 Twitters, I think it's very logical to say these things add a component of risk that we don't think is worth it. And it's really easy to, oh, I should have done this, I should have done that. I mean, people always beat themselves up. I should have bought Bitcoin at $1 or $2 or $10, but it's like, well, yeah, but the risk reward, I mean, the risk of it being nothing was extremely, extremely high back then. And so you
Yeah.
have to think in that mindset, right? Like, just to kind of encapsulate everything we've been talking about, which is if it doesn't fit your thesis and it's a good thesis, then you can't get too held up on the ones that you missed out on, because you're probably also not counting in the algebra of all the ones that if you had ignored that thesis, you would have invested in that would have done poorly. right? It's always
I have a
that
really good
reflection
friend.
bias.
Oh, of course, and that's, I think that's the thing that's so hard to get right in that postmortem is, you now know the outcome, and so it's so much easier to view the decision making framework through the lens of that outcome, when you should try to back in and be pure about it. But it's
Right.
helpful to know the outcome, to say, why did we think this person or this company was not a good bet and it turned out to be. Now, it may be that they got lucky, or it may
Right.
be that it really was a good bet and we didn't see it at the time. I have a good friend who I remember him talking to me about this at the time. Looked at WeWork back when WeWork was sort of in the couple $1 billion valuation, and he ended up passing on it because he decided that he didn't think that Adam Neumann was had sort of the right alignment with investors, and he just didn't understand the ultimate economics of the firm. And I think there was a time when, and we talked about it a little bit during this time, but I think there was a time when he was like, I was wrong, right? I mean, I must have been wrong about that, right? SoftBank comes in, it's $40 billion, are going to go public, and you're like, wow, I could have had a 20x on that. But of course, ultimately he was right. And so, those are tough times when you're sitting there and you think WeWork's going to go public at $40-50 billion. And you're like, I totally missed this one. I should have really pounded the table to do it at 2 billion. And then 6 months later, the company's essentially worthless, other than, a little bit of SoftBank money coming out of it. And you're like, oh no, I was actually fundamentally right.
Yeah. Well, I mean, it's like, in crypto, it can literally be the next day, right? And you think like, everybody was beating themselves up. They didn't have FTT token until suddenly, right, FTT token was worthless. But there was a journey along the way where it was every day was going up, and I missed out. Well, listen, I know we're really we're getting short on time, Seth. Really appreciate you joining. Maybe we can do a part 2 in the future, but this is a lot of fun. Thanks for being on. Yeah, same. Let's catch up soon.